We got another deal for you here today. This is a personal home care company based out of PA. Now, like every other video, I'm going to run through first impressions here. I didn't look through anything other than some high level to make sure this deal is actually interesting. We're going to go through the deal. We're going to go through first impressions on structure, retirement, whatever other stuff is in here. Then we're going to go through the numbers so you can see what it looks like and what it would take to get a deal to work. So, personal home care company. My guess, based on the title, this is not necessarily like nurses going to home. This is like PSWs, personal support workers, or similar going to home. So you're not highly regulated like a healthcare company. So we got asking 1.7 million, cash flow at 500,000, gross revenue at 2 million. Margin seems kind of high if this is just PSW work, and I mainly say that because really you're a staffing company at the end of the day in a lot of cases. However, if it's all private, so not backed by insurance or otherwise, I think the numbers may make sense in terms of margin, but a lot of ones that I've seen, when they're high quality insurance, your margins can get to 20, 30%. When it's low quality insurance, you're usually like sub 15% because you only collect so much. When it's private, then it similarly tiers out like high quality versus low quality. And it's mainly household income driven, to be blunt. But 10 years in business, not bad. Good enough time to build out some baseline. Seems like the seller is actually the one listing. Osborne Home Care Group, listed by Scott Osborne. I've never actually come across this, so this might be a brokerage. Never come across this firm, but if it is a firm, that's kind of cool. There's some folks that specialize in home care because it's a very solid sector. Let's see. So, managing owner seeks to pass on the torch to an acquisition entrepreneur. So they clearly want someone who comes from like the search funder space. So like the MBA guy who wants to buy their own business. Taking the franchise. Okay, so very interesting. So this is a franchise, in which case this multiple starts to make a little bit more sense. Um, Company provides essential personalized living assistance. So this definitely is not going to be like nurse level regulation. Franchises don't like to get into that level of headache. It means the buyer pool becomes really small and they want to expand numbers of franchises. Obviously, it's how they make money. 75% of clients self-pay either out of pocket or with assistance from a long-term care insurance provider. Policy, so specialized policy. That kind of makes sense then why the margins are where they are. 25% Medicaid, 90% older adults, so at home care. 90,000 senior citizens in the company's service area. Okay, so it's not number of clients because that would be a much larger company. Largest territory in the nationally branded franchise network. So obviously the franchise name itself isn't in here unless this is the franchise name, but I don't think it is. We have to see. I could do some background research, but that's not what this video is for, right? If you were looking at this listing, do the background research, see if this is a brokerage or whether this is the actual franchise network. Reason why I say that, if this is the largest territory and it's national, you want to see whether the franchise is growing or declining. Because if it's growing, then there's good opportunity, and they've obviously set themselves up well. The background network and everything is probably decent. If they're contracting or they're just really spread apart, the support's not going to be great. So you're kind of buying into a franchise without all the support to scale. But that said, we got 6 employees. They have an office, I guess, for the equipment and things like PPE and all that stuff, meaning like the masks and gloves and all that. Let's see. Nothing else really here is interesting. This is all just like nonsense. Sell the market. New owner will get training because it's a franchise. Reason for selling, career downsizing. I'm not super keen on this. Like usually when it's franchise and they're looking, like if they say they're looking to retire, different story. We've had franchisees and franchises that our folks have bought where they're looking to retire, and that's always a great scenario. They usually take over a really solid business. But when it's clear they have other stuff going on, and then they want to sell the franchise because they want to, remove distraction or focus on another business or otherwise, it usually means this is the beaten stepchild. And the problem is when it's a franchise and you already have tighter margins than normal, it's kind of a recipe for disaster in terms of quality of company. unless a lot of the staff are already handling a lot of the day to day. Like it depends on the scenario, but it's usually not the greatest of signs. So, I mean, overall, it's an interesting business because healthcare multiples are usually really high. So these multiples are really not bad. Let's plug this stuff into our quick vet calculator here, which, by the way, is available if you just go to the website. I mean, we use this all the time, so we built a tool specifically to be able to run through with these videos and make it easy for everybody. So I'm just going to plug in the raw numbers here. I'm going to assume, I mean, this might be listed by the franchise, but I'm assuming it's a brokerage. So this is actual SDE. This isn't like net profit. SDE meaning seller discretionary earnings. So they haven't taken out the cost of an operator to actually run all the working facets. So I'm going to assume for something of this size, it's probably like 75 or 80 grand a year in this area. For a decent operator, like you're not looking at a crazy high level, they've already run 50, 100 employees and thousands of accounts. That's not what this is. This is franchise. It's territory driven. 80 grand is probably on the higher end, I would even say, of what it's going to take. Now, because we have a cash flow discount here, I'm actually going to reduce this a little bit. So cash flow discount quite literally just discounts this amount here, assuming that the broker is adding in stuff that you can't really back into like an SBA loan or a bank. So like, the owner spending a bunch of money on travel or meals or whatever discretionary stuff that's going to be almost impossible to prove. This might be a little bit high for a franchise because we're also taking an operator cost out. So I'm going to balance this out a little bit, say 15% here, which is our minimum setup, and operator cost at 70 grand. And this, assuming you're also going to give them some type of equity incentive or profit incentive alongside. Working capital, I'm going to assume we're going to get it in the deal. Multiple's kind of low, but it's not super low, right? For a franchise, we usually want to be 3.5x or lower, really 3x or lower ideally. So this is a little bit above 3x. So I'm going to say we're going to get working capital included just to see how it looks. And let's assume you're not using an investor, right? So in a deal this size, you're coming in with 100 grand, basically. Let's see what that looks like. We can always go back and mess around with the investor stuff. So some assumptions here, just so you know what you're seeing. We're assuming interest rate 10.25%. That's like the high end of high end right now. But again, conservative is best. Amortization 10 years. That means you're going to be using an SBA 7A loan, standard 10-year amortization. Due diligence and closing cost of 4%. This includes what the lender is going to charge you, but also includes what you're going to have to pay someone on the financial due diligence end to do a proof of cash or quality of earnings, as well as legal to create your purchase agreement and all of the legal due diligence that they should be doing. And then buyer injection, we always assume 5% because you're going to offset the other 5% by a well-structured seller note. And I specifically say well-structured because the structure is what dictates you being able to actually do this and pull this off. So assuming you're getting about a 10% seller note here, that's the option one. Option two is assuming 20%. And this is just what does it take to get a 2 times debt service ratio? Meaning if the company cash flows $1 million, at most $500,000 is your debt service. So you're covering your debt needs by 2 times or more. So on a 10% note, seller's going to hold 170 grand. You're coming in with about 100 grand. It's 5% of total project, so it'll be a little bit higher than that, but roughly about 100 grand. Your loan is 1.5 million, and your debt service, your cash flow after all is said and done, and after placing in this operator is $241,000. Not bad. This is a workable deal. This is a little bit below where our comfort zone would be because the debt coverage ratio here is less than 1.5. We'd like to be 1.5 or higher so that we know that if shit hits the fan, we have a lot of wiggle room to make things right. So something more like this, I would say, is kind of the bottom end of where we would want to be. That way we're still net free cash flow on things. And sorry, I messed these up. Annual debt service here is the debt payments to the lender. Sorry. This is free cash flow. So 113 grand in free cash flow. And then your cost of an operator, 70,000. So 190 grand ish net free cash flow. It's tight. 140 plus your 70, 210. If you're going to step into operations, it's getting better. Roughly, you're closer to that 2 times debt service ratio if you're going to be the operator. This would probably be the low end of where we would get comfortable. This I'd say realistically is where it has to be. So either one of two things. Either one, you get a note around 30% or 25%, or what's more realistic is get this down to something like 1.6, or even I'd say 1.5 is probably where you want to be. And this is top end. Like this is really the high end of where you want to be. That way, even on a 20% note, your cash coverage is pretty decent. And this is being able to take 160 grand a year without having to step in and run all the show and run the ops. And if you take this out, so if you're going to be the one jumping in and doing everything, get a 20% note, you're clearing 230 grand a year net in your pocket. Not bad for a deal of this size. I mean, this isn't $1 million in EBITDA or cash flow deal, so you can't really pull everything and anything out of it. But for a franchise that has some decent operations, if you're going to come in and run it, if you can get them down to 1.5 and get a 20% note, ideally, probably I'd say 15 is probably the low end of where you want to be. Your cash flow is pretty decent for this size of company. Um, Not a bad deal. Not a bad deal at all. That said, there's a bunch more deals that we have on YouTube. Go ahead and check those out. We go through all types of deals. If you have a particular industry that you're interested in, drop the industry below in the comments. I'm always happy to go and look for deals and see if I can break down for you our insights on how we would look at a deal in that industry, or even the location. We're happy to look at location too, but industry tends to be more interesting. But otherwise, hit subscribe. Looking forward to seeing you in the next video.